Gross profit is the most important financial metric in your trades business. When we increase gross profit, those increases drop straight to the bottom line and will massively impact your bottom line profit. I've talked to hundreds of trades businesses. Only three out of hundreds of them had this reported correctly, which means they don't understand, most of us out there don't understand what gross profit is and why it's important. And another more alarming, I guess, perspective on it is your accountant and bookkeeper should, of course, understand the difference between gross profit and net profit. However, most all, not everyone, but most all accountants and bookkeepers are there to look in the rearview mirror at history for the purpose of focusing on tax exposure. And the net profit bottom line number is really basically the only number that they are there to think about and help you with. That does not move your business forward. The number that moves your business forward is gross profit because net profit gains come from gross profit gains. So the first equation we'll look at is pretty straightforward. Everybody here should understand this one. Sales minus expenses equals profit. That's a pretty straightforward equation. And there are two ways to increase profit in this equation, right? We can decrease expenses or we can increase sales. Those are the two levers that we can pull if we look at it this way, right? Most businesses out there focus way too much on expenses to try to maintain profitability when the real opportunity is to increase sales. And I'll help you understand what I mean by that. Obviously, we should be responsible with our expenses. We should not spend money on things that aren't helping us to move the business forward. We've got to be fiscally responsible with our expenses. However, there's only so much we can trim out of our expenses to help protect profit before we shoot ourselves in the foot. An example might be if it's a tree service business that you have, and we've got loans for a spider lift, and it's a couple of $1,000s a month to make that payment on the spider lift. We could stop making that payment, which would reduce our expenses. However, eventually the repo man's going to come visit and take his spider lift back home, right? So that's a problem. There's only so much we can do to reduce expenses before we shoot ourselves in the foot, okay? We could stop paying our insurance bill. We could stop paying our lease on our office, but that's going to become a bigger problem. So we want to be responsible with expenses, but that is not the real opportunity that we should be focusing our time and energy on. The opportunity that we should be focused on is increasing sales. The next thing we need to do is look at the next level of sophistication of looking at what happens in our business. So the most simplistic formula is where we started. Sales minus expenses equals profit. And if we come over to kind of the next breakdown of what those numbers mean, sales minus variable expenses, which is known as cost of goods sold, equals gross profit. And after we get to gross profit, then we take out our overhead or our fixed expenses. And once that has happened, we now have net profit or bottom line profit, right? Bottom line profit, make no doubt about it, that is our goal. However, what I'm going to share with you and give you perspective on is net profit gains come primarily, the vast majority of net profit increases come from gross profit increases. That's why gross profit is the most important number in your trades business. First, we need to look at the definition of cost of goods sold, the materials and labor associated with delivering our products and services. When your field team goes out to do work, let's say you've got a grading business, and you send your field team out with the Traco and the skid steer and whatever else you've got for equipment. You send them out to do some work over the next several days at a job site. All of the labor hours of those crews, all of the expenses associated with running that equipment, the fuel, the maintenance, um, and any materials like rebar or if you're doing fine grading and top grading, maybe it's grass seed, and straw, and I mean, there's all kinds of putting aggregate down. Whatever materials are involved in the work that you're doing on site, the labor and the materials associated with performing that work are those expenses all are considered variable expenses, and that's what cost of goods sold is. Next, let's look at the definition of what a fixed expense or overhead item is. A fixed expense is an expense that's not affected by how much or how little work is being done in the field. So those expenses would include insurance payments. It would include payments for equipment that you got a loan on. If you've got an office that you pay a lease on, it would include that. Any payroll for office staff. So, like if you got an admin person or a sales person, those expenses belong in overhead or fixed expenses. Marketing, although marketing can kind of come up and down through the year, and what you're spending each month, marketing is a fixed expense or an overhead item as well, because what is spent in marketing has no bearing on how much work is actually being done right now out in the field. It's a fixed expense. So fixed expenses, again, if we go back to the original simple equation, that's what we consider expenses in that simple equation are fixed expenses, the way that Action Coach looks at this. Increases in gross profit, generally speaking, drop straight to the bottom line. The reason that's true is because let's say that your business is doing $1.3 million in revenue last year, and this year it does $1.4 million in revenue. Okay. To increase a trades business by $100,000 usually means that, yeah, we've got more work going on in the field, but that's not enough of an increase to where we're probably going to need to buy more equipment or invest in additional marketing or hire additional office team, right? Or pay more in insurance. It's that $100,000 increase in revenue, the gross profit after you've paid for the labor and materials doing that extra $100,000 of work, it doesn't get gobbled up with the fixed expenses increasing. The fixed expenses stay the same. So the increase in gross profit drops straight to the bottom line. And the final thing that I want to share with you in this video is this perspective and the relationship between the real simple example we started with and the example where we built it out just a little further detail. The way that Action Coach looks at this equation, expenses represents fixed expenses, and the sales activity in the business represents everything that happens in the business all the way through to producing gross profit in the business. The ABOS system, the Action Coach business operating system that we use in trades businesses, the profitability model that we use is called the 5 ways profit chassis. And I'll be going into depth on how we use that to increase gross profit in another video as well. A quick recap: gross profit is the most important financial metric in your trades business. The reason it's the most important is because when we increase gross profit, those increases, most all of those increases drop straight to the bottom line and will massively impact your bottom line profit.